Welcome to the ACCA Paper P4 Advanced Financial Management discussion. Today we are going to talk about Treasury and Advanced Risk Management techniques. Now the Treasury part of the P4 syllabus is one which is considered challenging by people who do not work in this area on a day-to-day basis. It builds very much on the paper F9 with regard to derivative and hedging products for managing interest rate and currency risk. So again, if you haven't had a chance to brush off and look over your notes from paper F9, this would be a good time to make sure that one has a basic familiarity with foreign exchange, spot forwards, options, swaps, that kind of thing. P4 goes through these categories not only from a descriptive point of view, but also with their application, and therefore there is a fair amount of calculation that has to take place. Let's just briefly review or establish an overview of the sorts of things that we need to be able to master in the Treasury area, which is a significant part of paper P4. First is to be able to identify foreign exchange risk. So the typical cases in which a company would be long or short a foreign currency. And examples are given here to make sure that the terminology is well understood. Forward contracts are done. Here is mentioned over the counter. Over the counter would be a bilateral contract between a bank, for example, and a client. This is in distinction to derivatives, which may be exchange traded instruments, which are available not being created between a bank and its client, but being designed and made available through an organized exchange. We will see examples of this presently. Now, in order to hedge foreign exchange risk and keep in mind the paper P4, like F9, is looking at these treasury instruments mainly for the purpose of hedging. And to hedge means to protect oneself against loss. It's just a simple working definition of what we understand by hedging. And to be able to turn this into numbers, we have to have some, we have to make sure our technical toolkit is in good order. Now what you see here in this example would be the case of a company that is to receive £1 million in 6 months. Let's say it's an American company, and therefore they're going to receive a foreign currency in 6 months. The company will be concerned that the pound, in this case, which is the foreign currency, will decline in value during the 6 months. Therefore, the company would want to hedge its position, and one natural way of hedging a position when a receipt of foreign currency is expected in 6 months would be to sell forward that same currency, in this case the pound, and that would be the end of the story. What we have here in this example is a money market hedge. Now, money market hedges have been covered in paper F9 as well, and therefore this is a review. What we show here is a standard money market hedge structure for a company which is long in pounds. Therefore, it has pounds to be received in 6 months, and you can see here the money market hedge consists of borrowing £1 million for 6 months, meaning effectively you can see the hedge at work just with this first step here. If the company is has a receivable in pounds of 1 million in 6 months and is worried that the value of this will go down, it creates a liability in pounds. It borrows also 1 million, so that if the exchange rate of pound to the dollar changes, then both the value of the pound long position and the short position will offset each other. And that's in a nutshell, that's the nature of the hedge mechanism which is at work here. The rest is just simply to fill in the numbers and to understand how the numbers work. We also have here an example. If a company has to pay 1 million pounds in 6 months, the difference being, in this case now, the starting position is the pound. The company is short pounds. They have a liability in pounds. They have to pay out pounds. What to do? What is their risk during the 6 months? And the risk plainly is that the pound may go up in value by the end of 6 months. What is shown here is the structure of a money market hedge which addresses this kind of situation. And a confirmation of what we mean by long and short positions. Again, very important to make sure that we have our terminology straight, what hedging is meant to understand and to mean, and also how forward swap points, what they are and how they work. Again, this is very basic Treasury knowledge one needs to have, that the forward rate has a connection with the spot rate, and that connection is through the so-called forward points, as is illustrated here. Now, we spoke before of buying and selling currencies in the OTC market. That means with the bank as a counterparty. And now, in this section, we talk about currency futures, which means that the same transactions can be done, but they are done through the mechanism of buying or selling a so-called currency futures contract on an exchange. So let's just put here exchange. Exchange traded instruments, one of them being a currency future. Careful reading of this section and also detailed exercises, numerical exercises in the notes will confirm that in fact the use of currency futures has the same impact as an equivalent transaction done in the OTC market. They are all designed to assist the company in being able to hedge its foreign currency exposures. And you have an example here. This is the same example as the initial one. The company expects to receive 1 million pounds after 6 months. And outlined here is a possible solution to that story. In addition, there's some institutional detail with regard to using futures contracts with regard to settlement dates and the number of contracts and so on. These are all just institutional details that one needs to understand to be able to apply in a specific case, with accompanying numerical examples which I trust are self-explanatory. Also, there is the discussion of basis risk. Now, basis risk was conceptually described or mentioned in paper F9. In paper P4, the basis risk, of course, the definition is the same. It's situations where a hedge transaction doesn't exactly fit or offset the risk of an underlying, what we call an underlying situation. This is the initial the initial exposure faced by the company. And therefore the instrument selected for hedging purposes may not fit precisely the initial exposure, but may be an approximation and therefore leads to a mismatch. Now, an example of basis is also shown here. Where we work with a difference between a spot rate and the price of a Euro futures contract maturing at some point in the future. And the difference between the two allows us to project forward and to anticipate what the difference will be between the two rates as time progresses. And the calculations here serve to quantify the basis risk that exists in a given situation based on certain simplifying assumptions. Now the paper P4 is quite extensive in its coverage of derivatives contracts, so it will also cover currency swaps, and here one has again a pretty much standardized or plain vanilla currency swap for the candidate to visualize and to make very concrete, very vivid what the swap actually achieves, allowing a company to use a foreign currency and to be able to give that foreign currency back when they're finished with it without incurring a currency risk. We will talk about interest rates next time. Thank you.